I've been investing in real estate syndications for close to 10 years now, and I've learned quite a few things along the way that I wish I would have known before getting started. Investing as a passive, limited partner in real estate deals is a great way to get exposure to this asset class, to participate in some of the best tax benefits available to investors, and to access all of this upside within a real estate investment vehicle that's actually passive. However, there are some major pitfalls and potential downsides to consider before getting involved with syndication deals. So to share some of the biggest lessons that I've learned through investing with a wide variety of different sponsors across multiple different product types located in multiple geographic markets across the US. In this video, I want to walk through some of the biggest pros and cons I've experienced when going this route and some things that you may want to factor in before getting started. So let's start with the pros here, and one of the biggest benefits of going this route is the tax treatment associated with direct commercial real estate ownership. Now, this obviously isn't tax advice and every situation is going to be different, but generally by investing in a syndication, you'll be considered a member of an entity that owns a commercial property, and because of that direct ownership, you get to participate in the tax status that comes along with that ownership. And as a commercial property owner, you get to deduct depreciation expenses from your pro rata share of the income generated by the property. And this can be one of the biggest benefits of investing in syndications, especially since the Tax Cuts and Jobs Act was passed back in 2017. The Tax Cuts and Jobs Act introduced bonus depreciation for real estate owners, which allowed investors to depreciate up to 100% of the components of a property with a 5, 7, or 15-year useful life in the first year of ownership. And even though this benefit is now being phased out in 20% increments starting in 2023, this is still a huge benefit for investors that want to reduce their tax burden. And depending on the value allocation between the land and the building being acquired, this paper loss in the first year of ownership can end up being substantial, often far in excess of the property's taxable income before depreciation is deducted, which can ultimately result in distributions from operating cash flow being completely tax-free and significant carryover losses that can be used to offset future income generated throughout the ownership period. Now, in addition to the tax benefits of investing in syndications, one of the things I like most about investing directly in individual deals versus investing in REIT stock or a discretionary fund is that this allows you to essentially cherry pick the investments that you believe in most. By buying public REIT stock, you're essentially buying a piece of an entire operating company, which could be great for diversification purposes, but by doing this, you're also saying yes to all properties the company holds within their portfolio. But by investing directly in syndications, you're able to confine your investments only to the specific product types and geographic markets that you believe in most, and even the specific business plans that you feel most comfortable with. So if you only want to invest in stabilized industrial properties in the Southeast United States, for example, investing in syndications will allow you to do that. This ends up being a huge benefit to investors that have a strong belief or conviction about where the market is headed and want to take big bets to maximize the potential upside. And this also allows investors to avoid other sectors of the industry that they believe might be in decline and want to reduce their exposure to. Now, tax benefits and the ability to choose your deals are both huge upsides, but one of the biggest benefits of investing in syndications is that unlike other forms of direct real estate ownership, this is actually a passive investment. Even though you'll be a partial owner of a company and you'll be able to participate in the tax benefits associated with that direct ownership, in the limited partner position, you are not going to be the one responsible for acquiring, managing, or selling your deals. Especially if you already have a career you enjoy and you don't have the time or the desire to spend your nights and weekends talking to brokers and touring properties. Going the passive investing route can be a great way to build a portfolio. By investing alongside a group of partners, you also get the added benefit of being able to invest in larger, institutionally managed deals, which can often significantly reduce the risk associated with your investments, and this also tends to maximize your potential buyer pool in a variety of different market conditions. Now, even though there are a lot of positives of going this route, there are also some pretty notable downsides to consider, and the first thing to note related to the cons of passive real estate investing is that by investing as a passive limited partner, you're going to pay fees and promoted interest that create a drag on your returns. Passive investors pay fees at almost every part of the investment cycle, whether that's an acquisition fee when the property is initially purchased, an asset management fee throughout the ownership period, a construction management fee during a renovation, or a disposition fee at the time the property is sold. Investors in syndications also typically give up a significant portion of their profits, assuming the sponsor exceeds a predetermined preferred rate of return, which can also materially impact LP distributions when it's time to exit the deal. Now, in my experience, between all fees and promoted interest paid to the sponsor or the active partner on the deal, with project level returns on a deal in the high teens, so between about a 15 and 19% IRR, the drag on LP returns is usually going to be about 200 to 400 basis points, essentially meaning that if the investment at the project level earns a 16% IRR, the limited partners on the deal are usually going to earn somewhere between about a 12% and 14% IRR on their equity investment. And while this is a substantial drop-off from project level returns, when you step back and compare these types of returns to other passive investment vehicles with similar risk profiles and often less favorable tax treatment, a 12 to 14% annualized return is still really strong performance, especially over a 5, 7, or 10-year period. So even though it doesn't necessarily feel good to give up a few percentage points to the active partner on a deal, this drag can start to feel a lot less relevant when comparing this performance to other options in the market. Now, in addition to fees and promoted interest, another notable downside of going this route is the lack of control you have over your syndication investments, which can make it really difficult to plan from several different perspectives. As a passive limited partner, you won't have control over the amount or timing of operating cash flow distributions you'll receive. You won't have a say in refinancing decisions when an acquisition loan ultimately matures, and you also won't have control over the timing of a sale regardless of your personal circumstances. And these things can start to turn into problems if you're relying on your real estate portfolio to fund your lifestyle or your retirement, since distributions can quickly change based on market conditions. And this can also be a problem when it comes to tax optimization if you're trying to minimize capital gains when a property is being sold. To me, this is probably the biggest downside of going this route. And if you have a unique tax situation and you want to have full control over your investments, and when you choose to exit your deals, you may want to think twice about LP investing. Now, the last con I want to mention here might seem a little bit trivial, but this can actually become a significant issue as your portfolio starts to grow over time. And this is that the timing and the costs associated with filing taxes for these investments can start to get cumbersome in a few different ways. By investing directly in a real estate partnership, you'll generally receive a Form K-1 at the end of each year for each deal you invest in, and these forms are going to be required to file your tax returns. However, when you actually receive these completed K-1s can vary a lot from partnership to partnership, and since business taxes generally aren't even filed until the middle of March each year, this often results in your personal tax return either coming down to the wire or having to file an extension. Some tax professionals will also calculate your tax prep fees based on the number of K-1s you need to file, which can make these costs sometimes even more than the actual distributions you'll receive from some of your investments, especially on deals where you've cut smaller equity checks in the $5,000 to $10,000 range. Your personal tax situation can also start to get really tricky when you're investing in properties in different states, requiring you to file multiple state tax returns regardless of the location of your primary residence, which can again increase your tax prep costs and increase the complexity of your personal tax returns. Overall, there are a lot of things to think about before investing in syndications, but if you're looking for a way to invest in real estate in a way that's hands-off, allows you to pick and choose the specific deals you want to add to your portfolio, and also allows you to participate in the tax benefits that come along with direct property ownership, investing as a passive limited partner is definitely a path that's worth considering. And if you want to learn more about how to analyze real estate investment opportunities, whether you're a passive investor or an active investor putting together your own syndication deals, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking the CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on the specifics of real estate syndications or fund structures, make sure to hit the like button to let me know. And if you're watching this and you've invested in syndications in the past, let me know in the comments what your experience has been like and anything that surprised you about this process. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.